Hello, and welcome to the latest Expert Series webinar. Today's presentation is the Quest for Yield in an Uncertain Income Rate Environment. This is a complimentary ETF.com webinar courtesy of First Trust Advisors. I'm Ollie Ludwig, the managing editor of ETF.com. We are the leading authority on news and data about ETFs and the company behind Inside ETFs, the world's biggest ETF conference. Joining me today is Bill Housey. Bill is a senior vice president and a senior portfolio manager at First Trust Advisors. Before we get started, we wanted to cover a few housekeeping items. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during this webcast, you can click on the Q&A widget at the bottom and submit your question. We'll try to answer these during the webcast, but if a fuller answer is needed or we run out of time, it will be answered later via email. We do capture all the questions, so be sure to ask them if you have any. Also, a copy of today's slide deck and additional materials are available in the resource list widget that looks like a green folder at the bottom of your screen. And if you have any technical difficulties, please click on the Help widget. It has a question mark icon and covers common technical issues. Finally, an on-demand version of this webcast will be available about a day after this webcast, and it can be accessed using the same link that we sent to you earlier. The aftermath of the financial crisis has been characterized by ultra-low bond yields and a gnawing, recurring anxiety that rates are going to be heading higher and that the bond market will be a volatile place dishing out capital losses to investors who haven't done their homework and are vulnerable to such dislocations. And it's proven hard, even impossible, to know exactly how the macro economy will normalize. Recent history makes that perfectly clear. On the one hand, the Federal Reserve at its last meeting said it will now let the economic data do the speaking and drive the central bank's decision to raise rates. But barely 2 weeks went by and the Labor Department issued its worst monthly jobs report in almost 2 years. And all the while, Japan continues with its unprecedented quantitative easing program designed to keep rates low, just as the European Central Bank launches into QE in the Eurozone. The point is, there remain a lot of cross-currents in the economy, and investors are wondering. Fortunately, my guest is going to frame this entire post-financial crisis in ways that investors will find valuable. We're also going to talk about 2 income-generating funds that First Trust sponsors. And by the way, First Trust just won issue of the year at the recent ETF.com awards. I'd say it was because of its growing lineup of pure beta and niche strategies, its AlphaDex lineup of smart beta funds, and not least an interesting lineup of active funds. And the 2 funds we're going to talk about today are active. Those are the First Trust Tactical High Yield ETF. It trades under the symbol HYLS and has almost $500 million in assets under management, rapidly approaching that threshold. And also we'll be talking about the First Trust Senior Loan Fund, FPSL. It has $261 million in assets under management. Again, both are actively managed portfolios, and that may matter, especially in the fixed income world, and especially at this point in the recovery when the Fed is beginning to suggest that the time when it will raise rates is nearing. On that note, it's my pleasure to introduce to you Bill Housey of First Trust. Bill, take it away.
Ollie, good afternoon, and thank you so very much for having me, and thanks to ETF.com for having me this afternoon, and for all the terrific work that you all do to educate investors. And really, thanks to our participants for joining us. We're thrilled to have this opportunity to talk through the fixed income markets today. So really, I think it's important to frame out our discussion in terms of where we sit right now in terms of the interest rate picture. So let's set the stage for our discussion. We've got a 10-year sitting at about 1.9%, and as you can see on this chart, what I've plotted here is the 10-year Treasury going back to 1962. And so, as we're all well aware, interest rates have been in this secular decline for some 30 years now. Well, this is important because it presents an incredibly challenging environment for fixed income investors. Certainly it's challenging because it's difficult to find our clients' yield in this environment because investors are searching for income, but income and yield levels have come down to incredibly anemic levels. But I think what's more important is the massively asymmetric payoff that exists in fixed income today. And what I mean by that is, well, it's really quite simple. It's just bond math 101. If we look at this chart today and we look at where we're plotted today in terms of the 10-year Treasury at about 1.9%, well, your upside in fixed income is that little bit of white space below where we sit in zero. And your downside is essentially all of the white space above where we sit today from 191 or higher. Because essentially, if rates move higher, the bond prices will come down. And what's most important is that as yields have come down, the shock absorption or insulation we have against the changing rates has been mitigated or eroded. And so it presents a very challenging environment for fixed income investors. And frankly, we can put a finer point on this by just looking at some back of a napkin net math. If rates were to go to zero tomorrow on the 10-year, and let's just call that the best possible trade you can make if you were buying a bond today. Well, your upside, essentially with about a 9-year duration on a 10-year Treasury bond, is about 17% from about 1.9% in yield to down to zero. You'd get about a 17% return. Sounds terrific, but in reality, what we know is that the 10-year is not likely to go to 0% tomorrow. It's probably range-bound, at least on the lower end here for some time. So the upside is fairly limited. Importantly, if rates were to move up by, let's just say 15 basis points over the course of the next 6 months, it would wipe out a full year of returns if you bought that bond today. So that's how sensitive bonds are today to rate moves. And that's why it's less about timing. And so the primary topic of discussion in most conversations today is, when is the Fed going to lift off? Well, we would contend that it's less about timing things perfectly and more about understanding the potential consequences. So with that, in terms of the big picture, well, that's where we sit today, but let's think about this. We've got GDP on what we call a slow and steady pace. Our chief economist refers to this as the plow horse economy, slow and steady, 2.5, call it 2.5, 3% type GDP growth. Notwithstanding the most recent employment data that came out, employment has been pretty healthy in terms of the job creation rate, and frankly, if we just continue on this path, we'll finish the year at less than a 5% unemployment rate. So why is it that we continue to see our rates continue to decline in this environment? Well, what I'd like to try and do is offer a little bit of perspective on this from a supply and demand viewpoint. So first, where has the demand been coming from for Treasuries to drive yields down? Because after all, if the bond price is moving higher, the yield is moving lower, so someone must be buying these bonds. Well, let's start with U.S. banks. What I've plotted here for you is U.S. bank holdings of Treasury and agency debt. And what you'll notice is that this goes back to the beginning of 2013. Through 2013, banks were net sellers of Treasuries to the tune of some $40 billion. But in 2014, they went on a buying binge. And in fact, they amassed $175 billion of Treasury purchases in 2014. Well, why might that have been? Well, first, it's important to understand that banks are now subject to much greater regulatory scrutiny. And as a result, banks are now subject to the liquidity coverage ratio. And while they've been subject to this LCR for some time, it's important to understand that in 2015, it's the first year that if banks are not compliant with the LCR, they'll actually be penalized. So we saw banks go on this tremendous buying spree last year ahead of these regulations really kicking in full force and buying Treasuries. And so demand was up substantially from the bank side. Now, who else was buying Treasuries? Well, what I've plotted here for you are foreign official purchases of Treasury notes and bonds. And what you'll notice is that, much like what we saw with banks, in 2013, foreign officials, and when we're talking about foreign officials here, we're talking about foreign governments, so foreign government purchases of U.S. Treasuries. So foreign governments were actually net sellers of U.S. Treasuries in 2013. And you'll see the blue bar here are the foreign official holdings, and the orange bar is Belgium holdings. Now, Belgium isn't running out and buying our U.S. Treasuries, but foreign governments, foreign officials who don't want their identity to be known certainly do buy treasuries and park them in Belgium. And so there's always a good amount of speculation about who's buying those treasuries. But it's important to look at these in aggregate. And what you'll see is that after net selling in 2013, foreign governments were on a really strong buying binge in 2014 of treasuries. And in fact, they bought some $200 billion worth of treasuries in 2014 after having been net sellers. And so let's think about this. We had the Fed talk about tapering in 2013, their quantitative easing program. We had a lot of rate volatility. At the same time, banks were sellers of treasuries. Foreign officials and foreign governments were sellers. But last year, these foreign governments came back and became big buyers. And so if we think about what happened with the 10-year last year, well, certainly we went into the year, the 10-year Treasury was at 3%. But we finished the year at around 2%. So we had about 100 basis point decline there. And I think it's important that we're looking at these primary demand drivers to help us understand what was causing this to occur. Now, it wasn't, frankly, just the foreign official purchases. This is from the data from the Fed in terms of what we can track, but let's think about it further. Why might these governments have been purchasing treasuries? And it wouldn't be limited to just foreign governments. It would be inclusive of foreign pension funds, insurance companies abroad. Why might they all have been buyers of treasuries? Well, let's start by thinking about this in terms of currency. In 2013 into 2014, the U.S. dollar was very strong. And in fact, if you're a foreign government or you're a foreign insurance company or pension fund and you have money to invest in fixed income and you're looking at your domestic rates and you're looking around and you're watching your currency devalue relative to the dollar, one of the easiest trades to make is to just step into the foreign currency. And so, for example, if you were anywhere in the Eurozone periphery last year and you said as a foreign, as a central bank or frankly as an institution, you said, hey, I want to swap some of these euros for USD. Well, let's think, how might you have done? Well, in 2014, the dollar appreciated 13.6 against the euro. Pretty incredible return pickup, particularly if you were just left stuck in euros, what you ended up looking like. So I think currency was a big driver of what we've seen because it's been a very easy trade, particularly as the U.S. pulled away from QE and other central banks are putting the pedal down on QE and they're targeting their local currencies to weaken them. This has been a pretty well-televised trade and a relatively easy one. And in fact, if you look at it even in 2015, you have the dollar up about 10.7% against the euro. So currency has definitely been a big driver of this, whether it's been the Japanese or whether it's been in the euro periphery. This is what's driving demand our way. But in addition to that, it's important to understand that this is a relative world. And so while we might look at a 10-year Treasury yield of 1.9% and say, boy, that's a pretty paltry yield. If you're looking at it from Germany and you're looking at today an 18 basis point 10-year yield, negative yields through 7 years, boy, that 1.9% sounds pretty darn attractive. And in fact, as you can tell by this chart, this takes the 10-year U.S. Treasury against the 10-year German Bund going back through history. You can see there's a pretty strong correlation between these different rates. And so when we look at the difference between the 10-year Treasury yield and the 10-year German Bund, we'd find that the average delta over time or difference between the two has only been about 29 basis points. While today we sit at some 10 times the yield of what you can currently get on a 10-year German Bund. So we're pushing on these boundaries. And so what does it all mean when you pull it together? Well, for one, you have lower U.S. Treasury issuance because the U.S. government is running smaller deficits. We have strong foreign demand, as we just talked about, because the strong U.S. dollar and the significant pickup in yields that you can get in the U.S. relative to what's available anywhere, for example, in the euro periphery, where the only place you can get a better yield than the U.S. Treasury is in Greece. Everywhere else is a lower yield. So we have this strong foreign buyer demand. We have strong bank demand. And so the net result, which is what we tried to plot here, is negative net Treasury supply. And so this is something that's likely to continue to persist for some time, acting as an anchor in terms of the longer end of the curve for the U.S. Treasury. So when we think about
Bill, can I jump in really quick here? Just at the risk of making your job even harder. As I'm watching you and listening to you, looking at these charts, I'm reminded of what former Fed Chairman Alan Greenspan said about the conundrum. I think it was like in February 2005, saying even as the central bank was raising rates, the short-term Fed funds, the overall yield curve wasn't really cooperating. And then moreover, what about the demographic wave of retirees who want bonds because of their non-correlated aspects, and that's another piece of the demand pull. I'm wondering if you could talk about the conundrum for a moment, because we're 10 years later, and you could say this is the conundrum too if you want to get fancy schmancy. But also the retail pull, the retirees, the demographic waves here in Europe and Japan, kind of everywhere. I'm wondering if you can speak to that, please.
Yeah, absolutely. Very good questions. Thanks for raising that. So in terms of the conundrum, this is something we've been talking about now for several months. So what the consensus view today is that because of the things I've just articulated in terms of demand, that this is going to continue to weigh on the longer end of the curve. So even as the Fed begins to lift off, and let's think about this for a moment. We had a weak job creation report, but it's one piece of data. The reality is what we're likely to remember as we push forward through the rest of this year is that the Fed removed the term patience from the language, despite how dovish the commentary was. And despite this one little bout of data we've got here, over time I think what's likely to occur is the Fed wants to lift off. They want to reload the policy tools. So the Fed is likely to begin to push up the short end of the curve. And Ollie, your question goes right to this. 10 years ago, Greenspan called this a conundrum. He's raising short-term rates. Nothing's happening to the long end of the curve. And he said, we have this conundrum. We're raising rates, and we're not able to influence borrowing rates because nothing is occurring. Now, it's important to note that the curve was much steeper then. We are in this flattening and continuous flattening environment, particularly if the Fed begins to lift off, and we think they will. So later this year, you start pushing the Fed funds rate up 25 basis points. Eventually, over time, it won't be quick, as we all know. The Fed will eventually be pushing rates up, but even if they got to 75 or even 100 basis points, the reality is that's not likely to stall out this economy because we could certainly handle this such a low level of interest rates. I don't believe that would stall us out. But where this gets important is that you could be in a very flat yield curve environment then if you're pushing on 75 or even 100 basis points of Fed funds and you're at 1.5%, say, on the 10-year Treasury at that point. And so that's where the real challenge presents itself. And what I would tell you is that this Fed has some pretty incredible policy tools to contend with that they hadn't had before. So let's not forget that this Fed has amassed trillions of dollars of balance sheet. And they could simply wake up one morning and say, guess what, Eurozone periphery, if you want to continue to buy our bonds, well, guess what, we're going to sell some bonds today. And in fact, we'll plug your demand and we'll start by selling $1 trillion of treasuries tomorrow. Now, that's not a base case scenario, but it is one to reconcile some of this conundrum, if you will, that we've seen in the past with the current environment. And so I actually think that when the Fed begins to lift off, it will ripple through the longer end of the curve because the curve is so flat. And we will push some of these historical relationships that I've just described, particularly when I show you, for example, the U.S. Treasury versus 10-year German bond. Those relationships will be tested as the Fed begins to lift off, and if they aren't, and the Fed begins to grow concerned about a negatively sloped yield curve, which would ultimately lead to a recession, well, it's important to know that they have tools to contend with that. So I think that the conundrum was what it was 10 years ago. I don't believe we'll be facing the same thing this time. That is clearly, this flattening of the curve is clearly the consensus view, but I'd like to think that the U.S. leads, it doesn't follow, and we will lead rates higher once the Fed begins to lift off. And now, in bridging that to your next point about demand, well, Ollie, with that, I would say, it's clear that just like the banks buying of treasuries and just like foreign official purchase of treasuries, the U.S. demographic or foreign demographic is going to continue to create this demand for fixed income. And none of this is meant to say you don't own fixed income, but it is to say certainly you want to be wise in terms of how you own fixed income. And in fact, that brings us to the next slide, where what I've laid out here is the fixed income opportunity set. So when you have an aging demographic, they're clearly looking for income. Well, let's think about the trade today. In fixed income, you're either taking interest rate risk or you're taking credit risk. And so as we look across most fixed income, and let's just take the Barclays Capital Investment Grade Corporate Index. That is the bar 4 bars in from the left. And that's the yield of the index at about 3%. Well, you've got a duration, that's the orange circle, of about 7 years. So the trade today, if you're buying investment grade corporates, is one where you get a 3% yield for a 7-year duration. And in duration, we're just talking about rate sensitivity. That's not the maturity. We're talking about the sensitivity of these bonds. So it's just bond math. And what I mean by that is if rates go up by 1%, well, you'd lose 7% because of that 7-year duration. But you'd clip that whopping 3% coupon to be down 4%. So when we look across whether it's investment grade corporates or government bonds or the Barclays aggregate, what we find is that bond prices are at all-time highs. Yields are pushing all-time lows, and interest rate sensitivity is as high as it's ever been because duration risk is essentially a function of the current yield and maturity. So as yields have come down, it isn't like maturities have been extended, but yields have come down to a point where it's eroded your shock absorption. And so as a result, bonds are going to be much more sensitive to these interest rate moves. And that's why it's so important that when we think about a well-diversified fixed income portfolio, that we include areas like floating rate bank loans with, call it a 5% yield with almost no duration risk because they float, or high yield bonds where you can get 6 to 6.5% type yields with a roughly 4.5-year duration. And importantly, in high yield, the duration risk, it may be a 4.5-year mathematical duration, but in reality, what tends to happen in high yield is that as rates begin to increase, the spreads begin to tighten in high yield, and that helps to offset some of that rate increase. So areas like high yield bonds and bank loans can be very attractive complements to a well-diversified fixed income portfolio. And this, again, isn't a point to say run out and sell your bonds, because the bonds can act as real shock absorbers in periods of volatility. When the market is risk off, those high-quality bonds can act as shock absorption. But it is to say that it's important to have a well-diversified fixed income portfolio and include areas like floating rate senior secured bank loans or unsecured high-yield bonds, which can have a much different response to rising interest rates. So as we look at this a little bit closer, I think it's really important, Ollie, that we take a moment to think about fundamentals and valuation when we talk about bank loans and high-yield bonds. So when we talk about bank loans, on the left here, you'll see we've got a chart of senior loan prices and average spreads over LIBOR going back through history. And this is important because, when you look at fixed income, and as I just referenced, you have pretty much most traditional fixed income trading at all-time premiums, high premiums, and all-time tight yields. And so your compensation is very low relative to history there. Well, when we look at the $860 billion bank loan market, we see that the average price is trading right around par, and the average spread is right on top of the long-term average at about LIBOR plus 500. So from both a price and spread perspective, bank loans are pretty attractively priced. And now when we're talking about these loans, what we're actually talking about are just another form of corporate debt. We're talking about companies like Dollar Tree, who just bought Family Dollar, and they did it by issuing bank loans and high-yield bonds. Or PetSmart, which was just taken private by a private equity firm. And when that LBO occurred, it was financed with bank loans and high-yield bonds. And when Michael Dell took Dell private, he financed it with bank loans and high-yield bonds. And the same goes for Warren Buffett when he bought Heinz Ketchup, financed the transaction with bank loans and high-yield bonds. And by comparison, the $1.6 trillion high-yield market is trading much healthier today than it was, say, last June. Well, last June, we were in a high yield market where the price was pushing on an all-time high. You had yields below 5% and spreads pushing on 300 basis points. So not very attractive relative to history. But as we pushed through December, valuations became much more attractive because you had energy rollover and it repriced the market. And so today, we've got prices at around 101. We've got spreads of 440 basis points over Treasuries. So certainly, while a little bit inside of the long-term average, definitely better than the period of 05 through 07, definitely better than where we sat last June by probably 120 basis points. And so we feel like the compensation level and the valuations are much more attractive in these areas today. And as we push and think about it from a fundamental perspective, because, you know, folks, this really is the primary driver of returns in this area. So when we talk about credit risk, we really have to look at the defaults, because defaults are going to be the primary driver of returns. When defaults are high, the economy is rolling over and the performance begins to wane for credit investments. And so when we look at where defaults are today, well, boy, you can see we've gone through a period of in 08, 09 and trailing off into 2010, where we peaked at some 11% in terms of the corporate default rate. But we've been running well below that now for several years. And I think we're really just in the middle innings of this, because corporate fundamentals continue to be relatively strong. Cash balances are healthy. And so when you take out a couple of lumpy corporate defaults, which were vintage 2007 and 2008 LBOs, really poster children for what happened there. And by that, I'm referring to companies like TXU and Caesars that were acquired. You know, once you take those out of the data, what you see is that we're running at a basically less than a 1% corporate default rate for bank loans and high yield. So no real systemic problems there. Now, I think it's important, too, that when we look at these fundamentals, we start to think about what's the right approach to owning these asset classes. Because all high yield and bank loan products are not created equally. So how should an investor approach these asset classes? Well, for one, I think it's always important to really define and describe a passive approach versus an active approach. In terms of the passive approaches, when we talk about bank loans and high yield market, when you look at the passive approaches, the indices are constructed in a manner where the weightings are driven not by merit, not by a market capitalization, if you will, like an equity index would be. The weightings of a passive index are simply driven by the amount of debt a company issues. So, by default, if a company is fortunate enough to crank out a lot of debt into a hot market, it becomes a rather large exposure. Or taken from a different approach, if an industry grows as a percentage of an index, that is simply a function of that industry having had access to debt for a prolonged period of time. There's no better example of this than the oil and gas industry. On the left, I've plotted for you the Bank of America High Yield Index, and we've broken out the energy exposure, and you can clearly see that as the U.S. has gone through a shale revolution, energy companies have binged on debt, and this has gone from, call it 5% of the high yield market back in 01 and 02 to some 16% by the time September hit. And I think, frankly, a lot of people woke up in September when oil had come off from $105 a barrel in June all the way down to $50 a barrel and said, wait a minute, when did my high yield investment become a big energy bet? And as you can clearly see, this is what happened, because it isn't to say that these are good, high-quality energy companies. Frankly, some of these energy companies don't need to exist. They were successful at one thing, borrowing $1 billion into a hot market. When we look at the bank loan market, you can see the growth was there, but it doesn't represent nearly the same exposure as you can get as it was in the high-yield market at about 4.6%. So this is the challenge with a passive approach. A passive approach is just a representation of what companies have been able to access the debt markets. It doesn't speak to merit. Well, what happens if you run an active approach? Well, when you look at the strategies that we've managed and how we've weighted our energy exposure, what you'll see is that we've run considerably below the benchmarks by some 1,000 basis points in terms of in the high yield market and hundreds of basis points in the bank loan market. And it's important because what you want to understand is the wager that you're making when you're stepping into some of these situations. When we looked at the energy market and oil was $105 a barrel, we scratched our head because in reality, what's your upside if you're buying a high-yield bond at a 6% coupon and oil's $105? Well, your best case scenario is pretty much you get your 6% coupon and your principal back. What's your downside if oil rolls over? Well, it's infinite. You can lose everything. And so a very asymmetric payoff on a commodity trade. And from my view, look, it's one thing if you want to make that trade on the equity side where you get the upside and the downside. But it's a totally different trade if you're trying to do it on a debt piece of paper because your upside is limited to the coupon. And your best case scenario is typically that coupon plus your principal. And so that's why we think it's so important to run an actively managed strategy. And so, look, we run a very disciplined and rigorous and repeatable process around selecting assets. And that could be a little heavy in a presentation like this. What I would tell you is that we have a team of 12 investment professionals with an average experience of 18 years on the research staff running about $2 billion in this space. Our philosophy is actually quite simple. If we can capture yield and avoid loss through the cycle, our investors win. They don't win just on an absolute basis, but they win on a risk-adjusted basis because this approach is merit-based. It's about selecting companies that can actually repay the debt. It's about scrubbing the financials, understanding the cash flow, understanding the assets, meeting with management teams. That's what we do to drive the alpha. And I think it's more important to think about it in terms of the results than the actual process sometimes. And so with that, let me just show you. And what I've plotted here is FPSL. Ali mentioned at the beginning, this is an actively managed bank loan strategy. It's the best performing bank loan ETF since its inception. What you'll notice that in periods, what we plotted here is the bank loan market benchmark relative to FPSL. And so what you'll notice is that in periods where risk is on and the market is moving higher, this type of a strategy can lag a little bit because we're more focused on selecting the right assets. It's not about chasing yield or chasing returns. And so we tend to own higher quality assets than the passive benchmark. And so we might lag. And in this case, net of fees, we lagged 17 basis points through the first shaded area there. But what happens when the market rolls over and volatility picks up? Well, look at the period of June through January, where you had a down bank loan market, and yet FPSL presented a positive return. And so the delta between us and the benchmark was 136 basis points. We think that's what a good quality manager can bring to the table. Not just good performance in a good market, but strong performance in a volatile market. And net, as you'll see on the top, aggregate outperformance relative to the benchmark. So we think what we tend to deliver is we might not outperform every time, but we tend to outperform over time. And that's what a rigorous and disciplined approach can bring to the table. So in the bank loan category, this is what we've delivered. On the high yield side with HYLS, you'll see it's actually very similar. In the period when the Fed should taper, back in May of 2013, we show that period here, looking at February to June of 13. You could see high yield market negative, this product up 150 basis points. We had 185 basis points of outperformance. Now, through the period of risk on, we hung in there with the benchmark for quite some time, outperforming by a modest 17 basis points. Well, what I would tell you is that as we went through late last year, oil rolled over. And as a result, it brought down and repriced the entire high yield market. So in that period, it tended to pull everything down. And so when you look at HYLS, you had some outperformance. But if we just fast forward a little bit further and you look at this performance through March, what you'll see is you had a high yield market down over that period, let's call it from June till March of 15, down about 50 basis points. And we had a positive return in HYLS for a net delta of 80 basis points. And so while we just didn't have the data at the time we put these slides together, we've got it now through the end of March, and we show that once the smoke clears and the dust settles and the focus shifts back to valuation, owning the right assets is critical. And so HYLS is a strategy where we've gotten outperformance relative to the benchmark, net of fees of 244 basis points. And you can see it's not just about outperforming in a hot market. It's about strong absolute returns, but strong risk-adjusted returns as well. And so with that, let me just briefly summarize some of the highlights of this product for you. In terms of HYLS, The first product on the left here, that's our actively managed high yield ETF. SEC yield is 5.69%. It has a duration of just inside 3 years and 285 holdings. And so when you're thinking about how you want to position for interest rates, having a portfolio that isn't very long in terms of duration but can deliver a relatively attractive yield, we think is paramount. And doing it in an actively managed framework can absolutely deliver alpha. Again, this is the #1 performing high yield ETF on the shelf since its inception. In the bank loan side, FPSL, this has a distribution yield, or I'm sorry, an SEC yield of 4.06%. It has a duration of less than 1 year and has 216 holdings. That's actually twice the number of holdings than the passive benchmark. And so we think it's so important that we're on highly granular, highly diversified portfolios when investing in credit, because again, your upside is limited by your coupon typically, because the overwhelming majority of returns come from coupon. And so you don't want to take big outside bets on any given industry or any given issuer. And so we think it's so critical to run a very highly granular portfolio. And so to summarize, I guess, with that, look, we think the economic backdrop is very supportive of these asset classes. These tend to do very well in periods of modest economic growth and low corporate default rates. And so as long as fundamental corporate performance remains sound, these businesses can continue to refinance their debt, continue to pay their interest and principal, and so we think we've got a good runway with low defaults ahead, at least for the next couple of years here, for these businesses to perform well. And we think it's so important to run an actively managed strategy. When you look at the alpha we've generated, not just with respect to the benchmarks, but with respect to our peers, we've done it and not in a format where it's all about taking more risk. What we've tried to do is be incredibly thoughtful about risk so that we can be managing those downside drawdowns, but generating attractive returns for not only strong absolute returns, but strong risk-adjusted returns. And there's no better example than the performance that we've delivered to sort of manifest or justify why we think having an experienced team behind your credit solutions is so important, and that's what we bring to the table. So, Ali, with that, thank you very much, and I would love to try and take some questions if certainly you have any or any from the audience at this time.
Thank you. Thank you very much, Bill. Again, if you want to ask any questions, please do so, and we'll field them. I certainly have a few for you, Bill. Let's start with the performance of the. Let's talk about the senior loan portfolio first of all. I'm looking at some results you talked about since inception. Let's make it clear that your first trust senior loan active portfolio was launched in May of 2013, I believe. Is that correct?
That's correct. May 2nd of 13.
So I threw up a couple of charts. BKLN was the first to market. It's a behemoth of a fund. It's an index strategy. And then I also, for good measure, threw an active senior loan portfolio from State Street that trades under SRLN, and you may know this, but your security outperformed the other two. The index one by, well, we have 6% of more or less is your return since inception of FPSL, or FPSL, and then the BKLN, the index strategy, is about a little bit more than half of that, and then the senior loan piece from State Street, about 4.5. So you're on top, and I know you're probably not digging deep into these other portfolios, but you talked about the 12 people on your team and stuff. I mean, where does that difference come from? I mean, I was frankly surprised, you know, in a market that everyone's trying to get one up on the next guy, and you know, over that period of time, you've clearly outperformed. Is there any way you can sort of contextualize that a little bit more precisely to suggest what's going on there with your portfolio team that would relate to that sort of outperformance over these past few years?
Yeah, thanks, Ali. You know, I would tell you, first and foremost, when I look at attribution analysis, when I look at our funds and our strategies, and I look, because I analyze our performance every month, so I look at the results relative to the benchmark. What did we do well? What didn't we do well? We fleshed this out with our team. The primary driver of our alpha is credit selection. So it comes back to that disciplined approach. When we meet with 100 to 150 management teams a year, we do that because when we lend money to a company in the form of buying their bonds or buying their loans, we think it's important to understand what what their motivation is. If they're coming to the market to borrow $1 billion and then they're going to go spend it and then borrow another $1 billion and then spend it and borrow another $1 billion, well, that tends not to bode very well for my debt level. But if they're coming to borrow money to make an acquisition that they're then really going to be focused on repaying, well, those debt levels might improve. And so we spend a lot of time researching these industries and a lot of time researching these companies, and it's really that asset selection. There's, it is as difficult as we might like to make it sound at times. It's really quite simple. We're scrubbing the financials. We're looking at the asset value. We've got a lot of experience managing these investments through different economic cycles, so it gives us really strong perspective. And so it isn't about a single thing. It really just comes down to making sure that you own the right assets. There's an old saying that the first rule of bond investing is getting your money back. And we really view the world that way. I leave the pie in the sky upside to the equity guys, and for us, it's really about making sure that when we buy a bond, we're paid adequately for the risk, and that we think we're going to get our money back. And that's the primary driver of returns over time. It's asset selection and running just highly granular portfolios, trying to avoid a big downside drawdown for something that's unforeseen. Because I asked my compliance department, I said, hey, can I make a guarantee on the call tomorrow? And I said, I'm going to guarantee that something's going to happen tomorrow that I didn't predict. And they said I could guarantee that. So I'm going to guarantee that for you today, that something will happen tomorrow that I didn't predict. And the way we mitigate that risk is to run very well-diversified portfolios.
I presume that you're not too worried about the 85 basis point expense ratio on your security there, the senior loan one, versus 65 for BKL and the index strategy, and then I believe it's 70 from the one from State Street, SRLN. I mean, if someone comes out and you say, well, you're the most expensive, I mean, how do you respond?
Well, you get what you pay for, right, Ali? I mean, and the reality is, now we've demonstrated over time not just outperforming our peers by a substantial margin, as you've highlighted, but outperforming the benchmark as well. And we all know how difficult that is to do. And so to be tested in periods of volatility we think is important, and that's why we highlight that, to spend time talking about the way the fund performs in good times and in bad, and understanding the approach. Having a true active team behind credit is critical. It's something that we've always believed in, and so we think that it's worth the premium, and we think the results have certainly supported that.
Right. Now, I'd be remiss if I didn't bring up the question of liquidity, particularly in the senior loan / bank loan market. And we could extend this line of questioning into fixed income generally. Certainly relative to equities, fixed income is much less liquid. But with regards to bank loans, that in some people's judgment really is a very serious matter that needs to be understood very carefully. And I'm wondering if you might speak to that. That is the liquidity or perhaps lack thereof in the bank loan segment of the market. How has this impacted the market and the fund that you're managing now that we've been talking about for the past few minutes?
Yeah, thanks for that, Ali. We get this question a lot in terms of understanding liquidity. Barron's wrote a little story about bank loan market liquidity, and so it's great to have the discussion. I think it's just so important to educate folks who are looking at the space in terms of understanding what we're talking about. So when we look at the bank loan market, I think let's frame out the history of liquidity. Bank loan funds that began, mutual funds that I'm referring to, began to really take hold in the early part of 2000. So call it 2000, 2001. The first mutual funds started to come to the market that offered daily liquidity in the bank loan market. So when we look back through time, this asset class has continued to grow and grow and grow to the point where today it's about $860 billion. And the retail portion of FPSL, of the bank loan market, the retail portion of the bank loan market for retail investors is about 20-25%. The rest is held by institutions, and banks, and structured products. And so retail makes up a relatively small piece of it, certainly when compared to an asset class like munis, for example, where probably 80% of the makeup is retail. But this is an asset class that's lived through 2001 and 2002. It lived through 08 and 09, and it didn't live through it in closed-end funds. It lived through it in mutual funds that sometimes settle T+1 and sometimes settle T+3. And so, you know, the fact that bank loans are now in exchange-traded funds that settle T+3, it seems like suddenly liquidity is the primary topic of conversation. What I would tell you is that the new regulations that are imposed on banks is definitely having an impact on liquidity for fixed income. That isn't a bank loan problem. It isn't a high yield problem. It's a fixed income problem. So if it's corporate bonds, we've all seen it. And I tell investors all the time, expect greater volatility in the prices of your fixed income. When we look at 2008 and 2009, for example, banks had massive balance sheets, as we all know. Did that mean that they stood behind bids when the market was cratering and were willing to take on as much as I needed to sell them to meet the redemptions in my fund? Absolutely not. What they did was they said, well, Bill, my buyer cares 5 points back, and if you're a seller, that's where the bid is. And so I would articulate that as saying, look, that's sort of the new reality of fixed income today, unfortunately, because as liquidity has been pulled away from the market, there's been greater volatility in prices. In the bank loan market, the primary issue, at least in my experience, hasn't been an inability to trade. The primary thing that folks would like to focus or should focus on really is the fact that bank loans don't settle T+3. So the primary risk is that you have a settlement of T+3 on your structure, like your ETF, but if I were to go out and sell a bank loan, it's not required to settle T+3. The average settlement times, you know, could be a week or a week and a half. And so that is typically what folks are talking about when they talk about liquidity in the bank loan market. But what we would say is that, you know, we've been running these asset classes and structures that require liquidity like this for a long time. And we think it's important that you run a well-diversified portfolio, and our portfolios do carry some high-yield bonds in them so that they do settle T+3. We do carry some cash in the portfolio so that we can meet those redemptions. We do put a line of credit behind our funds so that to the extent that we were to sell a loan and had a mismatch on timing, we would be able to draw down that line to be able to help match fund that settlement timing. But importantly, what I would tell you is that in every period for which we've had daily active mutual funds, daily liquid mutual funds, whether 01 and 02 or 08 and 09, they've always been able to meet those redemptions in the manner in which they were supposed to because our counterparties worked with us to do so. So we go into our counterparty and say, we need to settle this T+3, and they've typically done that. Now, it's not something I can guarantee, but it's certainly something I can tell you has occurred in every one of those situations. But I know that's quite a bit, but I think it's just an important discussion point.
Oh, it is, yeah. Now, I was going to actually plumb one layer deeper and maybe look at this from a slightly different perspective. When we talk about the liquidity of an ETF, we're talking about the liquidity of the underlying, and I think that's really what you've focused on in the past few minutes. But we can also choose to focus on the liquidity of the ETF and maybe unbuckle the two and look at the ETF. If you work a trade very carefully, a bank loan trade of your security, let's say, with great care about the liquidity problem, working with an authorized participant, you could well end up in the driver's seat of a price discovery mechanism and in some sense possibly turn the liquidity issue on its head if you work your trade correctly. So my question is, do you agree with what I'm saying? And if you do, to what extent are you in a position to offer investors in your product this kind of hand-holding so that they do the right thing in the traffic and, in effect, neutralize a big part of the liquidity problem by working an ETF trade with a really high degree of sophistication?
Sure. Well, I think it's important that we again define what we're doing. So we're actively managed, and what that means is that we're not required to go out and buy anything or sell anything on any given day just because it's in a benchmark. When we trade our ETF, the easiest way to think about the way because I think a lot of times folks sort of say, wait a minute, what are we talking about here? We're talking, it's an ETF, but it's actively managed. That can be a little bit confusing. Really, if you took a mutual fund and you put an ETF wrapper around it, that's basically what we're doing. So when money comes in, we look at the market and we say, hey, we like this loan or we like this bond, and these are the ones we're buying. It's agnostic as to what's in an index. And when redemptions occur, It's the same analysis. We're looking for the best opportunities to buy and sell assets based on what we're seeing that day, and we're not required to do anything unnatural just because it's in a benchmark. And so that absolutely can drive better returns through those bouts of volatility. And so, for example, we work with a lot of investors who call us up and say, hey, we want to put in an investment into your ETF. Can you help us on execution? Can you help us work through this? And we absolutely do partner with those clients and work with them on that execution to ensure they get the best execution, as they need.
Perfect. Thank you very much, Bill. Now, another topic that comes up frequently in bank loans, and we'll get to the high yield in a minute. I'm giving a lot of attention to the bank loan, but I think it's an interesting proposition you're making here about finding a place in a portfolio. But one of the things that comes up frequently in the bank loan space is Libor floors. And given that bank loans are priced at 3-month Libor plus a spread, the addition of Libor floors in these transactions suggests that maybe the loan yields won't float when interest rates begin to increase. So can you offer some insights on this? We're getting deep in the mechanism of how these things work, but I think it's a fair and germane question.
Sure. So oftentimes people are asking, what's going to happen when rates begin to increase? Because these bank loans, these are just pieces of corporate debt, and they're rated below investment grade. And so it's important to denote we're talking about debt instruments that are below investment grade rated, but they're just corporations borrowing money from a bank, and then the risk is spread around. But the way we're compensated for that risk is that we earn a floating rate of interest. So bank loans aren't fixed rate like most traditional fixed income. They're floating rate. So we earn Libor, typically 3-month Libor, plus a spread for the risk that we're taking. So, in the case of a HYLS ketchup, it might be a Libor plus 275 type spread. But we say, wait a minute, HYLS, that's really interesting, but 3-month Libor is at about 25 or 26 basis points, and that's really not that compelling to us. In fact, with rates as low as they are, we'd rather insulate this low-rate environment with some Libor floors. And so what we say is, we'll take Libor plus 275 or 300 or 350 or whatever the case might be, but we want a Libor floor of typically 75 basis points to 100 basis points. So about 0.75% to 1% Libor floors. That's important because as rates begin to increase, they have to clear those floors before investors begin to see their rates float higher. And so one of the primary benefits of floating rate bank loans is that as rates move higher, the income component floats higher. So when you think about positioning ahead of rising interest rates, well, boy, this is a primary solution in that environment, and that's why bank loans typically have effectively zero duration or rate risk, because they tend to float higher. And so when investors say, well, what's going to happen when rates move higher because now we have these Libor floors, it's important to understand that in this environment, those Libor has to clear those 75 basis point and 100 basis point floors before the income begins to increase. Now, with that being said, I don't believe that introduces, say, interest rate risk to a bank loan because we have these floors. These floors are set so low that they're likely to be cleared relatively quickly. And I just don't see the market waking up and saying, wait a minute, the Fed is starting to raise interest rates. I better sell my bank loan because it's not going to rise more quickly. It's not going to rise very quickly. They're going to say, wait a minute, I better sell, this 7-year duration bond and buy bank loans because it's probably the best place for me to hide out while interest rates rise. And so I could put together a portfolio that has no Libor floors, and it would rise very quickly when rates begin to move up. But at the same point, I can hold on to my Libor floors and earn a higher rate of return. And I'm a bird in the hand guy. I take the money when I can get it for as long as I can get it. And if I can earn a little bit of extra yield by having Libor floors, well, that's just incremental compensation for the risk I'm taking. And it's not set at a level in terms of those floors that I think it introduces a lot more risk.
Perfect. Now, there was a couple questions came in. The ticker on this bank loan ETF that we are talking about is FPSL, as in First Trust Senior Loan. So just to make that perfectly clear. Now, an interesting, very rubber meets the road question came in from the audience here. Any plan to have these two ETFs on the Schwab One ETF list? The Source One was the commission-free platform that Schwab has expanded very aggressively in the past few years?
Well, that's a good question. You know, I'm joined here by one of my colleagues on National Accounts, Steve Yock. Steve, do you have any insights on that?
Good afternoon, everyone. This is ultimately something we'd want to be a part of. There is a lot of due diligence, and there's always the process of doing the research, making sure that we can work with Schwab One to get them what they need. But, you know, it's an ongoing process. It's something that we strive to be a part of. And right now, we're just kind of waiting to hear back from them. So it's something that we hear a lot of demand from advisors. So what we can do then is go to Schwab and Charles Schwab and let them know what the advisor demand is and just work with them, and hopefully we'll be able to add a few more to them.
Great.
Perfect. I wanted to devote a quick moment to the high yield security. There's some questions coming in about default risk in the energy space. Being actively managed, or were you suggesting earlier, Bill, that you were able to steer clear of a lot of that overexposure to that energy sector? You kind of see that people were they were borderline wildcatters heading for North Dakota with $1 billion in their pocket, or what?
Yeah, no, and I'm glad that was brought up. That was one of the points that I had forgotten to mention, and it's just to say that certainly when we think about the corporate default rate from an index perspective, you bet that if oil remains low, persistently low over the course of the next 6 to 12 months, there will be more defaults in the high-yield market tied to energy. But I don't believe that's a systemic problem. I believe it's an energy problem because as we think about this, with a low oil price, well, there's a number of people who benefit. Number one, 300 million people in this country just got a tax cut every time they go to fill up their tanks. And you've got plenty of businesses that benefit when consumers have more money in their pockets, and plenty of input costs on the chemical side start to come down, so certain companies benefit while others will come under pressure. So I don't perceive the challenge in energy. While it might drive up the overall default rate, I think we look at a world that's sort of X energy because we don't have the energy bets on. And so if you have a passive benchmark like HYG or a JNK as your ETF solution in that market, yeah, I mean, you've got a big energy bet on, and it's simply going to be driven by how much debt those companies have issued. And, you know, the more debt a company issues, the greater the probability of default. And so it's important that when you think about your positioning, just understand that you could have a period where defaults really begin to pick up in energy. Now, we see the oil trade today as being one of a dollar trade. So if the dollar remains strong, the dollar's backed up a little bit here of late, but if the dollar remains strong, oil is priced in dollars around the world, and just like a lot of other commodities. So we see a lot of headwinds with respect to the price of oil, and from a supply-demand perspective, you know, certainly, you know, there's a lot of talk about oil production coming up, increasing out of a place like Iran, and you've got the Saudis not really willing to cut production because they love the pressure this is putting on the Russians. They love the pressure this is putting on U.S. shale producers. And in the U.S., I mean, we've got storage continuing to build, and shale players are basically sitting across the table from one another saying, boy, I hope that guy cuts production, because if he cuts production, the price of oil will go back up, and then I'll make a lot more money. And they're all continuing to produce and produce and produce. And so we haven't really seen the supply-demand problem remedy itself yet, and it needs to remedy itself, not to be back into equilibrium, but the trajectory of the supply build relative to demand needs to change. So a lot of things can influence that, but we just haven't seen those things play themselves out yet. So yes, I do believe that that could drive up the default rate, but I don't believe it's a systemic problem. I believe it's an idiosyncratic problem, and I think you can absolutely position around it because companies like Charter Communications with cable subscribers, or Sinclair Television Broadcasting, or HCA Hospitals are going to continue to make money and continue to do all the things that they do just fine, even if some companies in North Dakota or the Permian Basin, start to go under.
Perfect. All right. Well, that about does it in terms of time. We did leave a few questions on the table. As I said at the beginning in my introduction, we will definitely answer those. We've collected them, and so we will reach out to you and make sure that your questions are answered by Bill or his colleagues at First Trust. Again, just to review, we talked quite a lot about FPSL, the senior loan portfolio. It is an 85 basis point security, has a solid outperformance over some of the rivals in the marketplace. We also talked very briefly about HYLS, an actively managed portfolio, competes with the likes of HYG and J&K that Bill had mentioned. And again, that is an active portfolio, and so too is the senior loan portfolio. So thank you very much, Bill, for being here. And I also want to thank the audience for attending and the questions. Again, this presentation will be available to all of you in about 24 hours, and you can access it with the same link that you used to get into this webinar. On that note, on behalf of my guests from First Trust Advisors, as well as all my colleagues here at ETF.com, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.